We're here at the Global Wealth Management event at the luxurious McIntosh Townhouse here in SoHo, New York. Joining me is one of the sponsors, Michael Underhill. He's the CIO and founder of Capital Innovations. Hey, Michael, thanks for inviting us here.
Olivia, that's my pleasure.
It is a very glamorous event. What's the reason behind it?
Well, I think it's more the experience, right? You have so many opportunities to be behind a computer screen and try and read the markets, understand the markets, communicate with others about what's going on in the markets, but it's a whole other level of complexity that we're dealing with today. So bringing people together off-site in such a venue where it's people from all walks of equity, fixed income, marketable, unmarketable, private markets. So if you look at real estate, private equity, venture capital, alternative investors coming here to actually talk about what's going on with current trends, as well as 2020 is an election year. So we're going to see significant volatility, uncertainty, complexity, ambiguity in the markets. Investors need to know what's going to happen in 2020. So that's why we're here today.
So, Michael, you refer to the world as bipolar. What do you mean by that?
Well, that's a great question. So, we look at the world and you're seeing an upwelling of populism. And you're seeing it in the US, you're seeing it with Brexit, you're seeing it in Chile with the protests, you're seeing it in Hong Kong. And so the upwelling of populism and protests leads to the volatility in the markets and a very much a perspective in which investors are saying, I need to be so far left or so far right. And they're taking very much a bipolar approach in what they see as very much a bipolar world. We have a lot of geopolitical unrest right now. And go ahead, I'm sorry.
So what approach do they need to take? You're saying they need to take not a bipolar approach, but a multipolar approach. What do you mean by that?
Yeah, absolutely. So when we look at it, a multipolar approach is being reasoned, rational, balanced in your approach of not only equity and fixed income, but also a healthy dose of alternative investments. So you think about infrastructure, natural resources, real estate, and getting into the private markets or private equity vehicles so you can have a bit less volatility in your portfolio and you can reduce your volatility, increase your income component, and have an investment approach that has a lower degree of correlation to the S&P 500 or the investment grade bond index.
So you like gold. Why do you see gold going up?
Yeah, gold is one of those things where it's a great geopolitical hedge. So when whether there's conflict in the Middle East, you see things like the weakening of the U.S. dollar because of heaven forbid, something like an impeachment occurring, and so you see the dollars pulled back in a very transitory manner. That's why you've seen gold bid up, right? You saw a strike on a large energy project in the Middle East, gold was bid up. So what you're going to see with more of this geopolitical unrest, more populism, more uncertainty and volatility in the marketplace, gold will hold a store of value for investors and will continue to ascend for the next 2 to 3 years.
Now, Michael, you mentioned real estate. Can you get specific with that, or do you mean in ETF form?
Well, so when we look at real estate, we're looking at private markets real estate. We look at publicly traded REITs. Not so much ETFs, but we're looking at direct investments in publicly traded REITs. So you could look at Digital Realty, you could look at companies like American Tower, and let's just take a look thematically. If you're trying to play real estate, a great way to play a real estate leaseback strategy is through American Tower, a real estate security, publicly traded, but it actually invests in cell towers and wireless towers in which the U.S. is trending towards 5G, capital intensive, great income. It's a real estate leaseback strategy and not a technology strategy, but it's tied to the technology-driven growth of investment in the U.S. And again, you get income, capital appreciation, and inflation protection.
That's exciting because it sounds like you're mentioning a lot of bond proxies. Are there any stocks that you like?
Oh, absolutely. So I look at energy stocks, and right now you're seeing energy stocks that are selling at a discount to fair market value, but less than replacement value. In other words, the actual assets that these companies own are worth more in sum total than the price of the stock and the way it's valuing today. And so we look at companies like Cheniere Energy, you look at liquid natural gas and what's going on with exportation of liquid natural gas. We look at some of these other companies that are in the midstream space, so master limited partnerships, companies like Kinder Morgan, as well as Energy Transfer Partners. You're buying a publicly traded stock, or MLP, in which you actually own physical assets. So pipeline operating companies, you're getting paid 6, 7, 8% dividend yields, but you have capital appreciation potential of 30, 40% over the next 12 months. So you get the capital appreciation plus income.
Do you have an S&P target?
Right now, it's 3% between now and the end of the year. If you look at it statistically, 93% of the time when the market's up more than 17% year to date, which it is, it will rally 3.2%. On average, 93% of the time. So from here on out, we'll see a 3% rally, a race to the finish, the end of this year. And then we're starting a 2020 year. Admittedly, it's an election year. I think we're going to see more volatility. I think we're going to see probably a 10 to 20% pullback, depending upon what goes on with potential impeachment hearings, as well as some of the things that are going on with geopolitical unrest in the Middle East.
Wow, well, those are some crazy calls. So it's good to be hedged. Thank you so much, Michael, and let's enjoy the event now.
Sounds great. My pleasure. Thanks.